Hey, welcome back. Today we're going to dive into one of the biggest, most important ideas in all of investing, diversification. We're going to get real about what it actually means and how you can use it to build a much stronger portfolio, one that's ready for pretty much whatever the market decides to throw at it.
You know that feeling, right? When the market's just soaring and it feels like everything you touch turns to gold? But we've all seen the history books, from the dot-com crash to the Great Recession. Market storms aren't a matter of if, but when. So the real question you have to ask yourself is your portfolio really built to last through that kind of storm?
And that's exactly where diversification comes into play. It's your secret weapon for weathering those storms. Look, it's not just some fancy buzzword, it's a real strategy. It's all about blending different kinds of investments together so you can manage your risk and hopefully see much steadier growth over the long haul.
And this really brings us to that old saying, right? It's a classic for a reason. If one of your investments tanks, if you drop one of your baskets, you've got others that can hold steady or maybe even go up. It's like a cushion that protects your whole portfolio from taking a massive hit.
Okay, so that's the what, but how do we actually do it? Let's jump right into the first of our 5 key tips for putting diversification into practice.
All right, first things first, the absolute foundation, the bedrock of any good diversification strategy is spreading your money out across different types of assets. And that means you're not just putting all your cash into, say, tech stocks, or even just stocks in general.
So you've got this whole toolbox to play with here. You can mix it up with stocks, commodities like gold or oil, and even get into real estate through REITs. And going global with your investments, that adds another awesome layer of protection. But here's the key. You've got to keep it manageable. For most people, spreading out across 20 to 30 really well-chosen investments is plenty. Any more than that, and honestly, it just gets way too hard to keep track of what you own and why.
All right, moving on to tip number 2. This one focuses on a specific kind of investment that can make diversifying a whole lot easier for you.
For a lot of people, index funds and bond funds are just a fantastic tool. Why? Because they give you instant diversification. With just one purchase, you get exposure to hundreds of different companies or the entire bond market. It's a game changer. Now, like anything in investing, there's a bit of a trade-off here. On the one hand, these funds, especially bond funds, can be a great hedge when the stock market gets choppy. Plus, their fees are usually super low. But on the other side of the coin, they're passively managed. That just means they follow an index, which is great for efficiency, but might not be the absolute perfect strategy in every single market environment.
Okay, tip number 3. This one's all about mindset. It's about shifting investing from something you do once in a while into a consistent, disciplined habit.
Yeah, you got to remember, a great portfolio isn't something you just build in a day. It's something you build over time, adding to it on a regular schedule. It's this disciplined consistency that really helps you take advantage of the market's ups and downs over the long run.
And one of the absolute best ways to do this is with a strategy called dollar cost averaging. It sounds complicated, but it's really simple. You just invest the same amount of money on a regular schedule, say $100 every month. When prices are low, your money buys more shares. When prices are high, it buys fewer. This totally smooths out the ride, and maybe more importantly, it stops you from trying to perfectly time the market, which is pretty much impossible.
But, and this is a big but, even with a fantastic long-term plan, this doesn't mean you can just hit cruise control and forget about it. Your portfolio needs your attention.
Look, buy and hold is a great strategy, but it's not buy and ignore. A huge part of managing a healthy portfolio is knowing when an investment just isn't working out and it's time to cut your losses.
This is where you really need to be engaged. You got to stay up to date on the companies you own and be aware of any big shifts happening in their industry. A smart investor knows when the story has changed for one of their investments, and they're not afraid to sell and put that money to work somewhere else.
All right, let's get to our 5th and final tip. And this is a big one because it's something that can just quietly eat away at your investment returns if you're not paying attention.
Think about it. Every single dollar you pay in fees or commissions is a dollar that's not in your account growing for you. That's why understanding exactly how you're being charged is absolutely crucial. So what this really boils down to is just being aware. It's awesome that so many brokers now have $0 commissions on stocks and ETFs, but you still have to watch out for fees on other things, like mutual funds. Sometimes they're charged per trade, sometimes they're monthly, they all add up. And just remember, while we all love a good deal, the cheapest option isn't automatically the best one for your goals.
Okay, let's tackle a question I get all the time. You buy an S&P 500 index fund that holds 500 different stocks. So you're fully diversified now, right? Well, let's break that down. Think of it like this. An S&P 500 fund? Awesome. It gives you a piece of 500 of the biggest companies in the US. But that's still just one slice of the pie. It's all large US stocks. A truly diversified portfolio adds in other things, like bonds, commodities, real estate, assets that often don't move in the same direction as stocks. That's what gives you real protection when the stock market hits a rough patch.
Now for the flip side of that. Can you take this too far? Is there such a thing as over-diversifying? Can you actually have too much of a good thing?
And surprisingly, the answer is yes, you totally can. It's called over-diversification. This happens when you just add more and more stuff to your portfolio, but it doesn't actually reduce your risk. For example, if you own 10 different tech funds, you're not really diversified, you just own a lot of tech. They're all probably going to go down together. At a certain point, you're just adding a bunch of complexity for no real benefit.
Okay, so let's boil this all down. What are the big takeaways? Building a strong, resilient portfolio really comes down to a few core ideas. Number 1, be disciplined. Number 2, have that buy and hold mindset, but always remember to review. And number 3, use a strategy like dollar-cost averaging to invest consistently. Master these habits, and you'll find investing can be rewarding, even when the markets get scary.
You know, at the end of the day, investing is a journey. Your portfolio is really telling a story over decades, your story. And by applying these ideas about diversification, you get to be the author. So the only question left is, what are you going to write in your next chapter? We'll see you next time.